Welcome back to the channel, everyone. Today, we're diving headfirst into the turbulent world of microcloud hologram. Their stock price has taken a nosedive, and investors are scrambling for answers. What could cause such a drastic and sudden downturn for a company seemingly on the rise? They're opting for a significant convertible debt sale, a move that has left analysts and investors scratching their heads. We'll delve into the intricacies of convertible debt, explore the potential reasons behind microcloud hologram's decision, and examine the potential consequences for both the company and its investors. So grab your detective hats and let's unravel this financial puzzle together. Now, for those unfamiliar with the world of high finance, let's break down this whole convertible debt sale thing. In essence, microcloud hologram is offering investors a chance to loan them money, a pretty standard practice in the business world. But here's the catch. These loans come with a twist. They can be converted into company stock at a later date. On the surface, this might seem like a sweet deal for investors. However, the market's reaction tells a different story. The sharp decline in microcloud hologram's stock price suggests that investors are interpreting this move as a sign of desperation. Why else would a company choose to potentially dilute its existing shares unless it was facing financial headwinds? So stay tuned as we delve deeper into the potential motivations behind microcloud hologram's decision and explore the potential ramifications for investors. Okay, let's get down to brass tacks. Microcloud hologram has announced not one, but convertible debt offerings. And get this, these offerings could potentially rake in a whopping $28 million each. Now, you might be thinking, why is everyone so worked up about this? Convertible debt, while a common fundraising tool, can be a bit of a double-edged sword. On the one hand, it allows companies like microcloud hologram to access quick cash without immediately diluting their shares. But if the company's stock price tanks, those debt holders will likely demand their money back, leaving the company in a potentially precarious financial position. It's a high-stakes gamble, and right now the odds don't seem to be in microcloud hologram's favor. So the million-dollar question, or should I say the $28 million question, is this: why is microcloud hologram so desperate for cash? The timing of this debt sale, coupled with the recent stock plunge, raises some serious red flags. Investors are left wondering if microcloud hologram is trying to paper over some fundamental problems within the company. When a company resorts to multiple rounds of convertible debt financing, it often signals that traditional funding avenues have dried up. Not exactly a vote of confidence, is it? Section 3, Dilution Dilemma: How convertible debt could impact existing shareholders. When those convertible debt notes are eventually converted into shares, it's going to increase the total number of shares available in the market. Think of it like adding more water to your orange juice. It might quench your thirst, but it's going to dilute the flavor, or in this case, the value of each individual share. This is where things get tricky for existing shareholders. As more shares flood the market, the value of their holdings could potentially decrease. It's a classic case of supply and demand, and right now the supply of microcloud hologram shares seems poised to skyrocket. So not only are investors grappling with the reasons behind this debt sale, but they're also left to contend with the potential fallout from share dilution. It's a double whammy that has left many feeling understandably anxious. Section 1, the silence of the insiders, a telling sign. All right, folks, let's talk about a curious little phenomenon we see time and time again in the world of finance insider trading, or in this case, the lack thereof, when a company's stock is perceived as undervalued. The folks in the know often jump at the chance to buy up shares at a discount. But here's the kicker, that's not happening with microcloud hologram. In fact, there's been a conspicuous absence of insider buying since the announcement of the convertible debt sale. When you couple this lack of insider enthusiasm with a massive debt offering and a plummeting stock price, well, it paints a rather unsettling picture, doesn't it? Section 2, lack of confidence. Do microclouds own doubt its future? This brings us to a rather uncomfortable question. Do microcloud holograms' own insiders lack confidence in the company's future? They're the ones privy to the behind-the-scenes machinations, the whispers in the hallways, the hushed conversations behind closed doors. So when these individuals, the ones with the most to gain from a stock rebound, choose to sit on the sidelines, it speaks volumes. It's like going to a dinner party where the host is frantically trying to convince you the casserole is delicious, but they won't even take a bite themselves. Section 3, reading the tea leaves, what this means for potential investors. Okay, so we've got a convertible debt sale, a stock in free fall, and radio silence from company insiders. What does it all mean for you, the potential investor caught in the crosshairs? Well, my friends, it's time to channel your inner Wall Street guru and learn to read the tea leaves. Investing in microcloud hologram right now is akin to betting on a horse that's trailing behind the pack, limping, and might be wearing an eye patch. The convertible debt sale, while potentially providing a short-term cash infusion, could come back to bite the company and its shareholders in the long run. Dilution is a real concern, and if the stock price continues its downward trajectory, those debt holders will be knocking on the door, demanding their money back. Section 4. Beyond the hologram, a broader market trend. Now, it's important to note that microcloud holograms' predicament isn't an isolated incident. The tech sector, known for its boom and bust cycles, has been experiencing a bit of a shake-up lately. Valuations are being scrutinized. Growth expectations are being tempered, and investors are becoming increasingly discerning about where they park their money. So while microcloud holograms' woes might be unique to their specific circumstances, they also reflect a broader trend in the market. Investors are no longer willing to throw money at every shiny new tech company that comes along, especially when those companies are saddled with debt and struggling to turn a profit. This is a wake-up call, folks, not just for microcloud hologram, but for the entire tech sector. The days of easy money and sky-high valuations might be coming to an end. Section 1. Reverse splits, a red flag fluttering in the wind. All right, folks, buckle up, because we're about to enter the twilight zone of the financial world. Reverse stock splits. In the normal, sane world of stock markets, companies split their stocks to make them more affordable when prices get too high. But a reverse split? That's like taking those 20s and awkwardly trying to tape them back together to make a single, crumpled 100. When a company's stock price plummets to embarrassing lows, they might panic and resort to a reverse split, but in reality, it's often a giant red flag waving frantically in the wind, screaming, "Houston, we have a problem!" Section 2, Anatomy of a Reverse Split, how they destroy retail investors. Now, you might be wondering if it boosts the share price. How bad can a reverse split be? Oh, my sweet summer child, let me count the ways. First off, it's often a desperate attempt to mask deeper financial issues, like our old friend convertible debt. But here's where it gets really sinister. Reverse splits tend to disproportionately hurt retail investors, the little guys like you and me. Institutional investors often see a reverse split coming from a mile away and can sell off their shares before the damage is done. But retail investors were often caught off guard, left holding the bag of now consolidated and often devalued shares. So, while a reverse split might seem like a harmless accounting trick, in reality, it's often a prelude to a whole lot of financial heartbreak. Section 3, From Bad to Worse, the case for investigating Chinese stock management. Now, while reverse splits are a global phenomenon, there's a particular corner of the market where they seem to thrive: Chinese stocks. Over the years, there have been numerous cases of Chinese companies listed on US exchanges engaging in questionable financial practices, including, you guessed it, reverse splits. We're talking about a pattern of behavior, a systemic lack of transparency and accountability that has left investors, both big and small, feeling burned and betrayed. This Wild West mentality might fly in certain parts of the world, but it has no place in the global financial system. Section 1, a call for action demanding accountability from Mullen Automotive Inc. Now, I know what you're thinking. This all sounds very concerning, but what can we actually about it? Well, my friends, that's the million-dollar question, isn't it? In the case of Mullen Automotive Inc., there are concrete steps we can take to demand transparency and accountability. First and foremost, we need to keep the pressure on. Share your concerns on social media, contact your elected officials, and make it clear that this kind of corporate opacity won't be tolerated. We need to demand answers, demand accountability, and demand better from the companies we invest in. Section 2, the Mullen morass, a tangled web of red flags. Now, let's be clear, folks. Mullen Automotive Inc. isn't just guilty of a few accounting oversights or missed production deadlines. We're talking about a pattern of behavior, a tangled web of red flags that should have investors running for the hills. From misleading statements about their technological capabilities to questionable partnerships and a revolving door of executives, Mullen Automotive has consistently prioritized hype over substance. They've mastered the art of the press release, promising the moon and the stars while their actual production output remains shrouded in mystery. And let's not forget the numerous lawsuits and regulatory investigations swirling around the company. It seems like every time you turn around, Mullen Automotive is embroiled in some new controversy, desperately trying to explain away their latest misstep. Section 3. Beyond Mullen. A systemic issue plagues Chinese stock listings. Now, it's important to note that Mullen Automotive Inc. is just one example of a larger systemic issue plaguing Chinese companies listed on US exchanges. For years, investors have raised concerns about the lack of transparency and accountability in these companies. And for years, those concerns have largely been ignored. Part of the problem stems from the different regulatory frameworks in China and the United States. Chinese companies are not subject to the same stringent auditing requirements as their US counterparts, making it difficult for investors to get a clear picture of their financial health. And let's not forget the issue of corporate governance. Many Chinese companies operate with a level of opacity and disregard for shareholder rights that would be unthinkable in developed markets. This lack of accountability creates an environment ripe for fraud and abuse, leaving investors vulnerable to significant losses. Section 4. Protecting the little guy. The need for regulatory reform. We need regulatory reform, and we need it now. The SEC must hold all companies to the same standards: stricter auditing, greater transparency, and real consequences. This is about protecting investors and maintaining market integrity. Section 1. The China Syndrome, a history of financial mishaps. Now, I know what you're thinking. John, isn't this a bit extreme, painting an entire nation's corporate sector with such a broad brush? And to that I say, fair point. It's crucial to acknowledge that not all Chinese companies are engaged in shady practices, but folks, the evidence, sadly, speaks for itself. We're not talking about a few isolated incidents here. We're talking about a recurring pattern of behavior that stretches back years. Remember the Luckin coffee scandal of 2020? This Chinese coffee chain, once touted as the Starbucks of China, was caught red-handed fabricating hundreds of millions of dollars in sales. It was a blatant case of accounting fraud that sent shockwaves through the market and tarnished the reputation of Chinese companies listed on US exchanges. And let's not forget the countless other examples, from reverse merger scandals to opaque ownership structures designed to obscure the true beneficiaries of corporate profits. The list goes on, a litany of financial mishaps that has eroded investor trust and cast a long shadow over the Chinese stock market. Section 2, leveling the playing field towards a future of transparency and trust. How do we repair the damage and restore confidence in Chinese companies listed on US exchanges? It starts with a fundamental shift in mindset. Embrace a culture of transparency and accountability. The US must stand firm on its principles. Hold all companies to high standards of financial reporting and governance. Ensure a level playing field for all. When investors have confidence, everyone benefits. Section 1. The final verdict, a call for transparency and change. So there you have it, folks. The curious case of microcloud hologram, and the murky world of Chinese stock listings. Investors deserve transparency and accountability. We deserve to invest in companies that play by the rules. The Wild West days of shady financial practices need to end. It's about protecting the integrity of our markets. Let's keep the pressure on, demand change, and hold those in power accountable. Stay vigilant, folks, and as always, thanks for watching.